faculty. He is, excuse me. There are also so this he is an eminent economist, basically in the areas of public economics, law and economics, and institutional economics, and he has done extensive research in this area. And after completing his PhD, he was with Harvard University on a postdoctoral fellowship, and because he is one whom we can from distance see as one of the brightest economists in India, who has gained almost all the prestigious fellowships. I can name Fulbright Fellowship, Commonwealth Fellowship, Erasmus Mundus Fellowship, then Ronald Coase Fellowship in Institutional Economics, Cambridge Advanced Program in Rethinking Development Economics. So he has been somebody who has been with the international institutions on a fellowship for a very long, extensive period as part of his career, and he has been publishing. I am not going into the details of his reading out his publications, but he has published extensively in the areas of public economics, law and economics, and institutional economics. And this is the second time he is here, and I'm happy to welcome you back, sir, to the Copley Institute, and thank you for accepting our invitations and to deliver this lecture especially. So this afternoon he is going to speak on the very interesting and important issue that do the wealthy underreport their income, which is I'm of course sure that given his credentials, he is going to take us through a journey where he always likes to, because of all his papers I have seen some kind of an empirical modeling also part of, apart from his theoretical these things. He has always been into modeling these things also, even GST vector and other things. I means many of these things I used to refer for my classroom lectures also. So thank you again, sir. So he has just reached from Delhi, so I'm sure that after teachers always get ignited once the students are in front of them. I'm sure that will not feel that tiredness once he starts speaking. So he will speak for say 45 minutes, sir. Yes, then we will open it for this. Thank you.
Thank you, Professor Harit. It was very, very generous, very kind introduction. Thank you for making me welcome wholeheartedly. Thank you, Professor Ranade, for offering me an opportunity to present my ongoing work. The work I'm going to present to you is I have just concluded its first draft, and I'm happy to present it to you in the hope that that I will be able to persuade you about the conclusions I have drawn and get your feedback, your suggestions, your critique of the same. So, as Professor Hari said, this is my second visit to Pune to the institute, and I wanted to take the opportunity to make a presentation here. So, the institute and its faculty and students, I have great regards based on my experience at this place. So, thank you again. Then I just want to make sure that you can hear me all right. I will be a little rushed because I want to share several things with you. But if you have clarificatory questions, do not hesitate to ask. Do ask clarificatory questions. Your comments and suggestions I will take up after the presentation is over. So this is the topic. The question is whether wealthy Indians report their income truthfully. Do they underreport their income? That's the question. So this question is important from several point of view. So one is that the tax collection depends on whether people report their income, how much of income they report to tax authority. More income we report, more tax they can collect given the controlling law, assuming that tax rates remain the same. So the tax department, income tax department is interested in this issue Researchers, policymakers are also interested in knowing, in addressing these issues because not depend on how much income gets reported, how much tax gets paid. It has bearing on inequality, the issue of inequality also. So tax regime, the tax is one important instrument to take away some income from those who have lot of it and redistribute through welfare programs or through direct transfers to people who have very low income levels. So on account of inequality, also this issue has become important, especially after the COVID, where media reports suggest that inequalities of wealth and income have gone up. And we are also interested in ensuring that our tax regime remains progressive. So for the tax regime to be progressive, it is important that people report their income truthfully. If the wealthy sections can get away by underreporting or reporting only a fraction of their income, then effectively tax regime will not be progressive. Progressive means that people, wealthier, richer people should pay tax, which is larger fraction of their income. So for this to be to be true in practice, we have to watch out for possible. We have to study the income reporting behavior. So that's the background. The question is, what do we know about the income reporting behavior of Indians, rich and wealthy Indians? In the media, I've been advised to in India. So in the media, you get reports of like this. So media generally report Akshay Kumar, a movie star, being the highest income taxpayer in a given year. So it's either generally a movie star or a cricketer that gets reported as a highest income taxpayer. So when do you become highest income taxpayer? If you report highest income under personal income category, right? To become highest income taxpayer, you have to report highest income and vice versa, right? Wealthy Indians, when I say think of 2, 3, 4, 10 wealthy Indian families or individuals, those names do not appear in the media. So wealthiest Indians do not appear on the list of people who are highest income taxpayers. So this much we know from media. Of course, these are media reports. There are limitations of information because the income I report to income tax department, that's a private information between income tax department and me. So there are media, but media may have their own sources. The point is that the knowledge who reports what income is not a public knowledge. So it's a private information. But from media, this is what we know. The question is, what do Indian researchers know about the relationship between wealth and income reported to income tax department? So far, Indian researchers, we have known very little because of data limitations. So we have not had any data source that provided information on wealth, individual wealth, and individual reported income simultaneously. There were no data sources so far. So as a result, researchers could not study the relationship between wealth and reported income. So that's the state of knowledge. This issue of relationship between income and wealth at individual level and household levels is under research in international context also. You might have, I'm sure all of you have heard of Thomas Piketty, who has written books and research papers on the relationship between wealth and income, capital income ratio. But almost all of his work and his team's work is at national level. Relationship between intertemporal relationship between national wealth and national income, not relationship between individual wealth and individual income. So in the international context also, this issue remains under research. So I'm going to present to you some findings on this particular aspect. Individual level, what is the relationship between wealth and reported income, and also at household level, the nature of relationships. And this study has been possible thanks to politicians and Election Commission of India. Since 2011, Election Commission of India has made it mandatory for every contestant to Assembly election and Lok Sabha election to file an affidavit and declare their wealth, all assets, including jewelry, bank deposits, vehicles, so all forms of assets and their market value, their value is to be reported in the affidavit. So the assets, all assets, therefore entire wealth is if you contest an election, you have to give all the details. So also you have to report income that you have reported to income tax department. So I'm going to use this as this is a new data source, and I'm going to use it as one of the main data sources. But I will combine this data.
Just for clarification, addition, that this is not only Lok Sabha and Vidhan Sabha, now it is at municipal level also and Gram Panchayat. Increasingly, the state election commission also are collecting data on income tax.
Wonderful.
Compulsory affidavit.
Oh, that's really good to know. So we can see that a rich data source is now emerging. I knew about assembly elections, but I didn't know that even for municipalities and panchayats it's happening. That's really, so you have given me more work. Thank you. So I'm going to combine this data set that is provided by contestants to Lok Sabha. I will call this data source as affidavit data, candidate data, or general election data. I will use these terms interchangeably. When I say general election data, affidavit data, I would mean the same thing. I will combine this data set with Forbes List because the wealthiest Indians generally do not contest election. So they are not there in the general election data. So to complete the wealth spectrum, I will combine GE data with Forbes List. And then for the income purpose, I will use again GE data, general election data, and statistics published by Central Board of Direct Taxation to complete the income spectrum, and have used other data sources that we will talk about. Now, coming back to the question. So before I show you the results, if I were to ask you that what is the relationship between wealth and income you would expect? You would expect a positive relationship between your wealth and your income. If you are wealthier than me, then you should be earning on average. This is of course not true for every individual, but on average, wealthier people should be earning more income. For two leading reasons. One is that most forms of wealth are source of income, or they facilitate, they increase productivity of labor income. So on both these counts, we expect positive relationship between wealth and income. By analogous logic, we would expect positive relationship between wealth and reported income. We would expect wealthier Indians should be reporting higher income and vice versa. So this is what we expect. But when I say that positive relationship between wealth and reported income, so what about should we expect the wealthier to report higher income in absolute terms or relative terms? That question is a matter of empirical investigation. Here, I want students' attention for a moment, even if you use in between, but it's important for you to keep in mind that I will present results on income, different forms of income, as a ratio with reference to wealth. So I will ask a question, how do absolute income levels increase with wealth? But more importantly, how do income levels increase relative to wealth? So I will use wealth as a reference point. And motivation is again twofold. One is that wealth is a direct and indirect source of income, capital income, and also it adds to productivity of labor income. And other is that the closest notion closest to income is wealth. So independently, also we want to study and find out how do your income reported by you and your parents compare with their wealth, and what is the nature of this relationship in general. Some notations, I will skip the model, but to give you flavor of the model. Some notations, W will stand for wealth and Y will stand for personal income. But personal income has two components. One is labor income income you earn or you will earn tomorrow by way of salaries, wages, other transfer payments. And other is what we call capital income, which is returns from assets. Your investment by your fixed deposits in stock market, in mutual funds, in real estate, and so on and so forth. So there are two components of personal income: labor income and capital income. Capital income, in turn, can be divided in two parts. One is what we call regular or direct income from an asset. So if you invest in a real estate, commercial property, or in stock market, you get direct income. If you are invested in stock market, dividends will be the direct regular income you get from your investment, the assets you hold as equity. They also tend to appreciate in value: land, properties, equity. So the second source of capital income is capital gains, appreciation in asset value. So just to sum up, personal income has two leading categories: labor income and capital income. Capital income can be partitioned in, or returns from wealth can be divided into two categories. One is the income stream and other is capital gains. For the reporting purpose,
one question. The businessman invested in our business. When that business income considered as a personal income?
so profits from business will be direct income. The profits that you earn from a firm or a company or from your, so that will come under capital income. Direct capital income would be the capital. So the reporting requirements, when you earn income, you have to report. If your income is more than 2.5 lakh per annum, you are required to report your income to income tax department. The reporting requirement is with respect to labor income or its forms and direct capital income: dividends, profits, interest you earn from fixed deposits, and so on and so forth. You are not required to report appreciation in asset values. So this unrealized capital gains are not subject to reporting requirements, to my knowledge. I think it's more or less correct. So, and the last bit, perhaps, where I want students' attention is the relationship between nature of riskiness of an asset, your investment, and returns. I want you to think of three types of investments. Think of you have some money. You can deposit it in a bank by way of saving accounts or fixed deposits. Think of fixed deposits as one possible investment, one asset. Other alternative is you can buy, let's say, commercial property using that wealth, money. Third is you invest in stock market. So fixed deposits, commercial property, and equity, capital market investment. What is the risk profile of these investments? Fixed deposits, savings are safest, commercial property is riskier, and stock market is riskiest in this category. What is the relationship between total returns? If we compare all the returns, all the gains that you will get from this investment, fixed deposits will give you some return, but less than what commercial property will give. Commercial property in turn gives you less than what stock market gives over medium and long term. So there's a direct relationship, positive relationship between riskiness of an asset and returns from it. But if we consider the direct income, remember capital income is direct and indirect. If we consider the direct income, then relationship is just inverse. So a fixed deposit, saving accounts will give you 4 to 5%. Even today, fixed deposits will give you quite easily 6 to 7% today, even though interest rates are not all-time high. But 6 to 7% interest you will earn. If you have 10 crores, you invest in fixed deposits, you will get easily 6 lakhs per annum. The 6% is less than what you will get from commercial property. What is direct income from commercial property? Rental income. Rental income in Indian cities are on average below 4%. 4%, less than 6% you will earn from fixed deposits. If you invest these 10 crores in stock market, what is the direct income you will get? That will be dividend income. What is the dividend yield rate? That is less than 4%. Actually, that's very small. Point is that as to the total return, risk and returns go hand in hand, but there's an inverse relationship between risk and direct returns. So this is something you may want to keep in mind. Now, here is something that is more of an exercise for students here. If we keep in mind what I have just told you, and we make basically this assumption that riskiness and returns, they go hand in hand, but riskiness and direct returns, they are inversely related. If you make these two assumptions, third assumption you make is that the wealthy individuals, they invest in risky assets. Basically, your attitude towards risk, your risk aversion decreases as you become wealthier. You make this, if you make the assumption of decreasing risk aversion, and you assume that your labor income is increasing, but concave function of your wealth. With this income, with these assumptions, it is possible to prove this. So the paper is available on demand, and proof is there in the paper. So under these simple assumptions, and I would say plausible assumptions, realistic assumptions, what we infer is that the income, personal income, will be increasing function of wealth. But if we compare personal income with wealth, the ratio, income-wealth ratio will be decreasing in wealth. Even though the numerator is increasing function of wealth, the personal income increases, but the ratio will be decreasing. So this answers the question, as a researcher, what do we expect the relationship? We expect the relations that the ratio, income-wealth ratio, should be decreasing in wealth. So wealthier you get, less income you will report relative to your wealth. So that's something we can keep in mind. So don't be super surprised when I show you the plots. As to now a little bit about the reporting requirements. So how do we go about reporting income? What are the reporting requirements for taxpayers? Taxpayers, as I mentioned earlier, are required to report all their labor income. I'm assuming if your annual income is more than 2.5 lakh rupees, you have to report all your labor income, wages, honorarium, and so on and so forth, and your direct capital income. Also, capital gains, if they are realized, if you sell your equity and you get capital gains, then that is also required to be reported. But the reporting requirement is mostly the labor income and direct capital income. From previous slide, we know that if all of us reported honestly, even if everybody reported honestly, we would expect the reported income wealth ratio to be decreased. If everybody reported honestly. However, actual reporting behavior is a matter of empirical analysis. So, because actual reporting depends on whether you evade or avoid paying tax or you hide your income. So it is a matter of empirical investigation. So now a little bit about, so this is the background. Before I show you the results, I want to tell you a little bit about the data. The data, general election data, affidavit data, it is a rich source of information with respect to wealth. So we get information on all the assets owned by the candidate and candidates and their families. So also income reported to the tax authority. I will say a little bit more on this point. And this data covers it covers about 7,600 households. That means twice the number of adults are covered in this data. But this data is about politicians, and you may feel that we believe that politicians are different. They perhaps are more dishonest. That could be one assumption. Then, so I mean, so ordinary Indians are less dishonest than politicians. This could be one assumption. So I will show you something interesting on this point. But what I want to show to you, oh, it keeps on going back when I look at. Perhaps I should avoid staying too close to the screen. So, but this data exhibits some properties which we would expect from a normal data. One property is that its coverage is really extensive. It covers from net debt of 51 crore to almost 9,000 crores. That's the range of household wealth covered by this data set. And income, it covers people who earn less than 200, who claim to earn less than 200 per annum, to people, households who earn close to 200 per annum. So its range on both counts is very extensive. I want to basically make a case that this is a useful data. Also, it passes smell test in the sense that the kind of concentration of wealth we get to learn from media reports. That also appears in this. There's a concentration of wealth. So top 10%, wealthiest 10% households account for 80% of wealth, 66% of income. So that's another feature that we expect. Yet another feature, and this is the axiom A3 assumption I stated about, that the wealthier people invest in riskier assets. That also is borne out by this data. So here, this gray color plot, it shows the share of equity, capital market investment in total wealth portfolio. So, and as you move down this direction, households become wealthier and wealthier. So this is percentile. So this plot shows how different wealth percentiles allocate their assets. The share of safe assets, which is blue line, it falls, and share of risky assets, this is gray, is equity, and orange is risky, is equity plus commercial property. Both are risky assets. Their share increases with wealth. So this is also one property that we expect from a normal wealth data, and that is expected here. Something that I showed you in the beginning, that wealthiest individuals are not highest income earners and highest income reporters, and vice versa. So the list of highest taxpayers is dominated by one group who are not necessarily wealthiest. That point also comes out nicely here. So if I pick up wealthiest 100 households in the data, then only 46% report income that belong to top 100 income levels. So the two sets are income rich and wealthy. They are different. They are different in this data set. So basically, there is some merit in using this data. Other point is that this is the only data source that is available on this subject. So we use it or not use it. So we prefer to use it. Third is that I will show to you that the patterns that I get from general election data, they fit very well with the overall the inferences that we can draw from other sources. I will say more on this. Now, so for this slide, those of you, so I see here many students, and perhaps you have not started to file income tax returns. Whenever you do, hopefully soon, that will be soon, you will report. One will be your true income, whatever it is. You will report some of your true income. So it's plausible to assume that your reported income will not be more than your true income, but you will report income. When you report income to tax authority, you will report income under two categories. One type of income you will report is income you claim is taxable. You tell the tax department that I earn this income, it is taxable. This will be like your salary. Other is that you report income, but you say that it is not taxable. For example, if you own farmland, farm income is tax-free. You are required to report it, but it is tax-free. In the past, dividend income up to 10 lakh was also tax-free in your hands, but you are required to report it. So point is that all the income that you report, you can be partitioned in two parts. Reported income is equal to income reported as YT, T as in taxable, and YEX is exempt income, tax exempt income. So you report income under two categories, taxable and tax exempt. Clearly, total reported income is going to be greater than income you report as a tax greater than or equal to. A little bit, perhaps this is the last slide about concepts and accounting practices before I present the results. Within the income, you report as a taxable. So suppose you earn, let me go back momentarily. Suppose you earn 12 lakhs or 12 crores, whatever, whichever number makes you feel better. You will report some of that income as taxable. Suppose it's 12 lakh is your income you report, and you have reported 12 lakh as 10 lakh as a taxable income, plus 2 lakhs coming from farm income and so on and so forth as a tax exempt income. So you have reported taxable income 10 lakhs as a taxable income. Just because you report 10 lakhs as your taxable income, you do not pay tax on the entire 10 lakhs. We have, but the income tax department is very generous. Government of India is very generous. They allow you standard deductions. They say, okay, you have reported 10 lakhs, you pay no tax on 2 lakhs or 3 lakhs or something. So if if the income reported as taxable is 10 lakhs, you will pay tax on amount that is less than 10 lakhs. You enjoy standard deductions. So the actually tax, so total taxable income then now is income deductions, let's say 2 lakhs. On remaining 8 lakhs, you will pay tax. Your total reported income was 12 lakhs, 10 lakhs as taxable, but actually taxed income, TD, actually taxed income TD is only 8 lakhs. So this is the relationship. So conceptually, your true income, PID, personal income, is expected to be greater than your reported income, which in turn is greater than taxable income, which in turn is greater than actually taxed income. Maybe if it is too much, I allow you to ask 1 or 2 clarificatory questions.
I have one information.
Yes, please.
Is this VDIS or similar scheme in operation?
What is that? Voluntary disclosure scheme.
It was very old.
They were year specific. They appear once in a while and cause some blip under some income brackets, but overall they don't seem to make a
Not reported income counts as.
Yes, that's right. Yeah, but those are really minor compared to the overall reported income. They were the last time, I think 2016. Yeah, it was. Okay, so this is the conceptual framework. When it comes to estimating how am I doing in terms of time?
Yeah.
Only.
What I know to share.
So when it comes to now, okay, when it comes to, so conceptually we know that this is the relationship, but when it comes to estimating income, there are data limitations. Even general election data provides me information about TD. So if you contest elections, you are required to report all the forms of wealth and income. What is the income you are required to report in your affidavit? That is TD, actually taxed income. So in technical terms, in technical terms, the DE data provides us information on actually taxed income and not taxable income, not total income reported by any individual. Or yes.
Why haven't we considered the exempt income in this relationship? Because it could be like someone might try to show a larger part of their income in exempt, so they try to save.
So this relationship will still be true even with that, but when I present to you regression results, I will come to this point.
But we can estimate once we know the.
So, right, so the question, so I just want to take you through how I estimate. So fortunately, income statistics published by Central Board of Direct Taxation, they tell us the relationship between TD, YTD, and YT. So using statistics published by Income Tax Department, we can find out the relationship between YTD and YT for different income groups. And that is what is done here. This is the relationship that emerges. So the relationship is fairly consistent across years. So I have plotted here this information for 6 years. The relationship is fairly consistent. This relationship is used to estimate YT, taxable income from YTD, for GE, for general election households and individuals. For Forbes List, to estimate this top income levels for Forbes List gives us information on wealth, but not their income. But that, again, I have used statistics of Income Tax Department to identify top income levels reported to Tax Department using a technique called generalized Pareto interpolation. Basically, if you have a distribution of income or wealth, you can reduce summary statistics. This technique allows you to back out distribution from summary statistics. So that's the technique used. So through this process, I am able to estimate YT, taxable income. But still, we have to estimate exempt income. To estimate total reported income, to estimate total reported income is YT that we have estimated. We also need to estimate exempt income. The exempt income is mostly labor income is not exempt income. This income comes from farmland and some forms of capital income, some other forms of capital income also qualify as exempt income. To estimate exempt income, I have estimated capital income for different categories of wealth, for different categories of assets. And there, for example, equity income is estimated using rate of dividend yield of top 100 or top 500 private listed companies. Agricultural income, we do not have the data, disaggregated data on how agricultural income compares with price of agricultural land. So I have estimated a range working with different assumptions, assuming that farm income is just 1% of the value of farmland to 4%, 5%. Point is that the different assumptions are made to estimate returns from assets. And I will present the entire range to you. So now is the time to show you the results. First result is the relationship between wealth and absolute income. This result is as one would expect. There's a positive relationship between wealth and reported income. So that's what we will expect. So here in this plot, you see, if you focus here, there are curves, blue and gray. The green zone shows you presents a range of estimated exempt income, because estimated income is estimated under different assumptions. So here I have presented the entire range. The point is that all forms of income, net tax income, taxable income, total reported income, that increase with wealth, as one would expect. So that's so this is a kind of a broad view. It is this curve is not flat here. It is, if you look at its microscopic view, it is increasing everywhere. The things are interesting if we look at reported income as a ratio of wealth. Then we get these curves clearly present, just the opposite picture. The income as a ratio of wealth, income relative to wealth, it behaves in a completely opposite direction. Income as a proportion of wealth. So absolute income increases, and it seems like it blows up at the top wealth level. So it seems like wealthy individuals are reporting a lot of income. That's the message that comes out. But if we compare their reported income to their wealth, it sinks to very low levels. For least wealthy families, the income wealth ratio, reported income is 4 to 5 times of their wealth. But this ratio keeps on decreasing. Again, this is the entire spectrum, all the households percentiles depicted here. And this is microscopic view of top 50 percentiles. So households at middle wealth level, they report income that varies between 10 to 14% of their wealth. So reported income is just 14 to is at most 14% of their wealth. Moreover, the reported income as a ratio of wealth, it keeps on decreasing. For top 1%, it comes to around 3%. For 0.1% wealthiest households, the reported income amounts to just 2% of their wealth. For Forbes listed families, the reported income is less than 0.5% of their wealth. So that's the relationship that one gets. So, and this is the range. But one unmistakable inference is that the income relative to wealth, it decreases, whichever way we look at income. The wealthy groups report less income in this sense. But remember the results. This is the pattern that we expect. Income wealth ratio is expected to be decreasing. So the question is, are these results surprising? Well, the direction is not surprising, but magnitude is. I will tell you why these numbers, these magnitudes are surprising. Before I come to that point, I will wind up in 5-6 minutes maximum. So I want to show you empirical exercise. Basically, this message comes out very, very nicely. Either we study income wealth ratio of households or individuals. I'm skipping this deliberately, hoping that someone will ask a question. So these are the results. These are the econometric OLS estimates for individuals. Individual income wealth ratio regressed on host of factors. Log of wealth, so this is the log specification. Then the share of different assets are used as regressives. Share of banking, share of equity, share of commercial property. I want to draw your attention to sign of agricultural land. So as share of agricultural land increases in wealth portfolio, ceteris paribus, other factors held fixed, it is associated with lower reported income. Households that have larger share of agricultural land, they report less income. Something like this you were perhaps thinking about. Also, households that have larger share of commercial property report less. So and criminals, candidates with criminal records, they also report less income. But what is surprising is, what is interesting is, see the coefficient of vote. What stands for vote share of the candidate? As the vote share increases, you report more income. At given wealth level, controlling for other individual characteristics, candidates that have larger vote share report higher income. This makes sense. As your vote share increases, you expect that you are seriously in the race. If you're seriously in the race, you don't want to fall. You don't want to err. You don't want to take a risk of losing your candidature by misreporting your wealth or income. There's a penalty. There's a provision for imprisonment if you misreport. Of course, you get disqualified as a candidate, but there's a provision for imprisonment also for misreporting of income and wealth. So, and one can see that one message that comes out here is this variable, vote share. It shows that media scrutiny, social scrutiny, because all these documents are publicly available. You and I can look at these documents. Media can look at their claims. But media doesn't learn about my claim, what I reported to income tax department. Greater is the scrutiny, greater is the reported income, and vice versa. This sign also shows that, contrary to popular perception, when politicians may be more corrupt when it comes to amassing wealth and income, but when it comes to declaring, it seems like they are more honest than non-politician Indians. So the estimates that I have presented here, they basically underestimate the magnitude of underreporting. That's the message that comes out here. Now I want to make just 2 minutes. I want to take to tell you why these results, even though we expect these results to be downward sloping, why they are surprising. Question is that should we expect? What is the magnitude of income wealth relationship we should expect? Should we expect? We know that the income wealth ratio should be decreasing in wealth, but should it be less than 1%? Should it be less than 2%? Should it be greater than 6%? That's the question. And here, my submission to all of you is, I provide you 2 reference points. One is that if we use national accounts, using national accounts, we know share of capital, share of wages, and share of capital. It is around 40%, slightly over 40% share of capital. So if we use share of capital in national income and use information on wealth stock of country, then rate of return on capital turns out to be at least 7.2%. So this is the average rate of return on capital. This is average rate of return on wealth put together. So if we look at just the capital income, the average capital income is 7.2%, more than 7% of capital stock, more than 7% of wealth stock. That's one reference point. We expect the rate of return to be higher for wealthy groups because they invest in more productive, more profitable asset classes. But this is a good reference point. Other is that what I mentioned earlier on fixed deposits can give you direct return of 6 to 7%. Mutual funds give you higher returns. So compared to this reference point, the figures we get they are low. What we get is less than 3% for 1%, 0.1% report income, personal income that is less than 2%, and Forbes List report income that is less than 0.5% of their wealth. So, and therefore, I argue that wealthy groups underreport their income. I'm not saying that they hide their income, but they underreport their income compared to the reference points that I have mentioned. If we look at the total income reported as a proportion of just the estimated capital income, most households upper in the top 30%, they report total reported income is less than the returns on their wealth. And this problem becomes more pronounced as households become wealthier and wealthier. The point is that even if we look at just their capital income, their total income can't justify even their capital income. Estimated capital income is way higher than reported income by wealthy individuals and households. It has 2 implications. Literally last 2 minutes. 2 implications it has. One is that it renders our I'm kind of exaggerating things, factually correct, but conceptually I'm exaggerating. But happy to get scrutinized by you. It renders our tax regime regressive. So in academic writings, in media reports, we are known to be a progressive tax regime, in the sense that the tax rates applicable to marginal income that gets reported, they increase. If you report more income, applicable tax rates go up. And that gives you, if you look at only the reported income and tax rates applicable, you get blue plot, our tax regime becomes progressive. But if you compare tax liability with wealth, then it is progressive up to a point. Beyond that, it becomes regressive. Tax liability as a percentage of wealth, it decreases at the top wealth level, and at the very top wealth level, it is well below tax liability, relative tax liability for even low, middle, less than middle wealth levels. The other implication is that that it leads to underestimation of income inequalities. The existing estimates by Banerjee, Piketty, and several others have estimated income inequality in India. All these estimates are based on statistics published by Income Tax Department. I have argued that today I will try to persuade you that the income reported to Income Tax Department is not the entire income enjoyed by wealthy groups. So part of the income does not appear in statistics published by Income Tax Department. Therefore, the studies on income inequality, they miss out on income levels, substantial fraction of income levels at top wealth levels. And to that extent, they underestimate the income inequality. So I think that's it. Then there are, yeah. So. So I'm happy to.
Some short question, maybe some substantial questions. One is this decreasing expected direction of decreasing income to wealth ratio. It's a direct consequence of your concavity assumption, right?
Concavity and the inverse relationship between riskiness and direct income, direct regular income.
So, but that concavity is an assumption.
Yes, concavity or with respect to labor income. With respect to labor income.
But then your main point was, even though the functional assumptions you have made about labor income that predicts a lower declining ratio, you were surprised to see that the decline is much more.
Yes.
And that magnitude difference is between 7% and 2%.
That's right.
Roughly.
Yeah, I think that's one meaningful reference point.
So this one, or I mean, I don't want to take. See, there is a large number. Two things. One is, suppose you take somebody like this. I'm taking an individual. It's not fair. But let's say Mr. Premji. Azim Premji, I think used to own something like 85 or 90% of Wipro. And he used to be among the richest Indians and possibly in a Forbes List also. But that is the impute, that is the value of, let's assume that most of his wealth is in his company, not farmland. So that value is say $10 billion. The $10 billion wealth is equal to share price of Wipro multiplied by the 85-90% stock that he owns. But you know that this is a very slippery concept, because the moment you even try to sell even 2% of the stock,
Yes.
the share price may fall so much drastically that his wealth will go down by half.
That's right. Yes.
That is the nature of the beast.
That
So
is
therefore, it's a very, very slippery, unstable concept to say that it's $10 billion worth, because even if you try to get 1 billion out of the 10 billion, the stock price will fall down by 50%. So he actually cannot invest.
yes, there are regions like this.
So therefore, it's not surprising that his income out of a $10 billion wealth of owning Wipro is going to be a tiny percentage of it. And therefore, it's not fair to compare it to fixed deposit and to something else. At the very high end, this is what's going to happen.
There are 2 points you have made. One is the fragility of the value of stock. And
No, not because of volatility. No. Not volatility at the stock market.
no, not the stock market, but the fragility of
If the owner of the company is unloading even a tiny bit stock, it's highly predictable. I mean, it's not volatile.
So that's what I meant. Not vis-a-vis, the stock market itself is volatile. On top of that, there are structural reasons, that can generate volatility, and they may not want to divest. That bit I agree. My response would be that over medium and long term, that still remains in India and elsewhere. Stock market investment still remains most productive form of investment. That would be my one response. But the second point you made is that therefore it is expected that his income will be, a wealthy person's income will be a tiny fraction of their wealth. That does not necessarily follow. Because the return, as I said, national accounts suggest the return on capital is 7% consistently. And as you become wealthier, your ability on all counts to make most use of all the investment opportunities that are available to you, in general, that goes up. So it does not follow that the income has to be really tiny fraction. There are other reasons. Let me take the opportunity why I think these numbers are so low, 2%, 1%. It's not at the top wealth level. I don't think they are avoiding tax or they are hiding income. That's not, in my view, that's not what is going on. My results do suggest that a share of agricultural land and commercial properties, they are associated with kind of tax evasion. People hide their income. But the wealthiest on the Forbes list, they do not invest. They're even if they own 5,000 acres of farmland, that's nothing compared to their wealth stock of wealth. So at the very top wealth levels, it's very difficult for them to hide their wealth and also their income. But they can manage their income. Their primary source of their income is twofold. One is the salary they get, salary commission on variance they get by serving on their group companies. And other is the dividend income is what they get by way of capital income. So for the wealthiest, they earn, actually, let's use, I will not state the names, but these are media reports and you can. So faces you see on this slide, their income that appears in their individual accounts and in their tax accounts would be the income they get by way of salary, honorarium, commission, and capital income will be dividend from the equity they own in group companies or otherwise. Now, if I were to ask you about dividend income, what is the dividend yield rate in India? If you look at top 100 private listed companies, dividend yield rates are less than 1%. Who decides what dividend yield rates will be? Who decides how much of profit will be distributed as dividend? It's CEOs and these people who decide what will be dividend. So basically, in economics, we think that income is a well-defined concept. It is. But when it comes to its implementation for tax purpose, income for wealthy groups, income is what they choose it to be. They can choose, what fraction of profit will be distributed as dividend. They keep dividend distribution low because dividend invites additional tax. If you keep dividend distribution low, you can plow back profits into your company. That increases prospects of company, that augments your wealth level. So that's the primary reason. Other is if you can read here. So can you read here? I don't want to read it out. Can you read this? So Indian wealthiest of Indians, they report. Sure, in media you have it. This billionaire, this wealthiest Indian has kept his salary fixed for last 10, 12 years, or took nil by way of salary. And these are presented by media as if these are virtuous things to do. The same logic applies. If you are a wealthy person, you own, you have your group companies. If you take out more by way of your salary, your commission, it will come from the profit. Your income you take to your individual account will be reported to tax authority. You will pay tax at the rate of 35-36%. But if you don't do that, if you keep that low, you choose your own salary, right? This is true. These groups choose what their salary will be. if they pay themselves more, it will be good for us because there will be more tax that will be collected, but it's not good for them. So it's not charity at work. It is the response to it's the tax management that's going on, that's making these people look so charitable. So I think these are the two channels. Basically, they choose their labor income, they choose their capital income. That's the
So from a policy perspective, how to get out of this enormous?
honestly, I am not ready to answer this question yet. A part of me feels that no, I don't have good answers yet. I would like to think more. But it is not an easy problem to deal with. The one way to deal with this issue would be, look, so CEOs will always be in a position to choose dividend distribution. After all, it's their decision. Right? We don't want to take that decision away from them. If we want them to decide what profit, what fraction of profit should be distributed as dividend, then if we want to respect their right, then we want to think, should we increase the profit, the rate at which profits get taxed? The temptation would be you increase corporate taxes, but it's not easy. You can do that, but many of these guys will take away their capital elsewhere. So it's a problem that I would like to submit. I have identified only a problem. Today I do not have solution. I would like to propose a solution, but today I don't. Then some of us might be tempted to think in terms of wealth tax. Why don't we tax their wealth? That is also not easy. Especially, you see, throughout the world, 50% of wealth is held as a residential property and real estate. For the Indian scenario, for middle class, upper middle class, wealth, residential and other real estate is the dominant form of wealth. So question that we have to ask is, should we be taxing the property that you own? Some people are wealthy but are not income rich. Some people inherit wealth, so you accumulate pension, you invest in property appreciates. But if we start taxing blindly, then it can lead to problems. So no, I don't have a good answer.
In the technology, is there any difference after this demonetization? You have seen the
Right. Okay. Thanks really for asking this. I have interesting. That's really. Thank you. Indeed. I completely forgot about this one. So this dummy, you can see from here that there are clear fixed effects. So the data pertains to two years, the 2014 general election and 2019 general election. So of course, all the income and wealth, they are normalized. The analysis is carried out at constant prices. Still, there are fixed effects. It shows the fixed effect. This coefficient shows that in 2019, controlling for wealth level, other individual characteristics, people have reported more income. So other factors have fixed. In 2019, people reported more income compared to 2014. What was the difference between 2014 and 2019? There were several steps were taken, including the one that you mentioned. So, Benami Property Act, or DST, demonetization, all of these measures were adopted in between. And from this analysis, it appears that together these initiatives have led to greater declaration of income. Income tax.
One again clarificatory question. So you have about 6,000 and 7,000 population.
Right, 7,000.
And this income that's reported or wealth in the affidavit consists of reporting to the entire family. It's not only the individual.
Individual
So
and
you will take only the entire family.
so this regression is on individuals. The previous one is on households. So this analysis is carried out at three levels. One, the candidate level, individual. Second is wealthiest member of the family. So candidates are not always wealthiest members. So separately from them.
Because it's without consequences, the woman is handling, but the husband may be.
Right. So that's why wealthiest member level. So two categories of individual level analysis and also the entire household. So, for three categories.
The gender and then reserve and leisure, they also report it.
So a candidate reports income for himself, herself, spousal income, and dependents income. And also that.
There are also assets declared like gun
Yes.
ownership.
Yes.
So how did you compute the value of a gun?
So I don't. So they themselves report whatever, maybe purchase price or whatever, but they are really small. In other categories in the
And the election commission guidelines do not, in fact, do not expect them to report their wealth at current market value. So some of them choose to, like, there are politicians in Mumbai, Bandra, their flat value is 5 lakh rupees. Nowhere in Bandra you can buy a flat, but they report. But the election commission does not distinguish. They neither penalize nor incentivize. So the guidelines, some people may truthfully say my flat is worth 5 crores. And some people may, actually a large proportion of them report at acquired value, meaning cost of acquisition. So that, noise in the data you cannot.
right. Yeah. So this is a very interesting point. I think guidelines do say that they, let's say for 2019, it was March 2019 that was.
When the guidelines were issued.
March 29, you are supposed to declare the values of assets as on March 2019. But even with that guidelines, the guidelines only clarify conceptually. This problem does not disappear just because there are guidelines. So we under the.
Higher sides.
So let me.
Again, higher
Yeah.
sides.
So,
I think there will be-
okay, so floor is, I have been handed out the floor, so let me respond. So if I fail to respond, then support will be welcome. So this analysis is also carried out, keeping in view. So the one leading assumption that I made is, so this problem is true for politicians and non-politicians alike. Whenever we sell or buy properties, we underreport the prices. Circle rates, stamp duty rates are reported as the transaction rates, not true. So not true property value are reported. So I assume that that's an issue here also. But as you said that it does affect magnitudes, but not the direction. So I have carried out the analysis by assuming that there's a underreporting to the tune of 30%, for example. So it will pull these dots down, but not at the top level. Remember, at the top level, real estates are not dominant form of asset class, and equity you have to report what it is. So the direction and top level magnitudes, they will still survive this issue.
Sorry, in this discussion, so one more, this discussion actually is very fascinating. In the elections, usually I don't think people who are big stock market wealth owners, usually there's very tiny fraction of those kind of people.
That is why they are brought in here separately.
For example, I don't know if you have covered Rajasthan, so I don't think you did Rajasthan. Someone like, let's say, Vijay Mallya. So he also had to report, but that's not part of this. So therefore, when you said, you showed photographs of Ambani and others, but actually in your data, 7,000 candidates, I doubt if there's anybody like Ambani, with high, must be just about 10 or after the.
You are absolutely right. So technically, there's a one person in the data who belongs to both general election and Forbes List. Nandan Nilekani is the person who belongs to both. Jindal also, the Jindal 1 year belong, not other. Naveen. So technically, but that's the reason that they do not contest elections. So these were exceptions. So I have brought in Forbes listed individuals and families separately. Yeah. So and so now it reminds me actually. Thanks for raising this issue. So two things are unmistakable. So these two data points, they do not come from general election. They come from Forbes List and Central Board of Direct Taxation. So at the top wealth levels, so this is what we get, income wealth ratio. And at the bottom of the wealth pyramid, we expect income wealth ratio to be very high. Think of people, rickshaw pullers, people who work as daily wages on your campus, elsewhere you see. They have very little by way of wealth, a tiny house in some remote village. That house will be worth maybe 50,000, 60,000. That's their wealth. That may be their only wealth they have, maybe a few thousands in some bank account. What is their income? Even at minimum wage, their income will be more than 2 lakhs. So you would expect their income to be 4 to 5 times of their wealth. So the point I want to make is that what we can infer from independent sources, very high income wealth ratio at low wealth levels and very low at the top wealth levels. So general election data fits in nicely. It kind of nests nicely with that. Thank you so much.
So, like, many wealthy people who are owners of certain corporations, they try to buy their personal assets in the name of the corporation and show it as an expense, so they get the tax benefits. So that wealth doesn't get reported in this wealth data in their as their personal wealth, and that also reduces their taxable income because they are showing it as an expense.
Right.
And for this reason, they even try to create certain dummy corporations, or they'll show some, they'll create just a company to save tax. So did you come across any such?
So, if you examine accounts of companies, annual accounts of leading companies run by wealthiest families in the country, you look at their shareholding structure, individuals hold a small fraction of shares directly. Direct ownership is very small. In some cases, it is some substantial. Like in case of Nilekani, most of it is held directly. But other wealthy families, they do not hold their equity stakes directly. They hold through what's your name?
Shalini.
Okay, so entities like limited liability partnerships, body of individuals, association of these financial intermediaries are used to hold their stakes. This also means that the income, if I invest through an intermediary, then dividend income will also come through in the account of intermediary and not my account. So what I have tried to do is, so I have taken all the wealth owned directly and also indirectly, and then tried to estimate their dividend income. Still, it looks like this. So that is what I have tried to do.
So just to add to what you said.
But this is very,
Just to add to what you said, Ratan Tata never shows up anywhere as the richest in
It's never-
Ratan Tata never shows up as any richest list.
yes.
Because all the ownership is through the trust. But he actually controls a very, very large trust. So that control, of course, that's a very complicated process. Because ownership is not only eligible through trust.
Yes.
In fact, even Azim Premji founded his own through a family trust.
Yes.
That's going to complicate it.
So, and precisely for the reason you have mentioned, I could make some sense of only companies promoted and run by wealthiest 10 families. I could not carry out this exercise for the entire Forbes list because the financial engineering is so messy. I think even their chartered accountants hired by them may not be able to tell us, what's going on. I could not, but only for 9, 10, I could make some sense.
So Anil Ambani declared bankruptcy in the London court.
Yes.
His net worth is negative.
Yeah.
In a court filing. Court filing.
Any other question? Yes.
So a bit of a tangent, but I have to ask you. This government talks a lot about India-centric policy making. As in literature, we say sensitive policy making. Would you tell us some policies that we should be, or we are applying to combat this problem is different than countries that have similar wealth structure than ours?
What our whether our policies are different.
Yes, please.
Oh, you got me. I think your vice chancellor is in a better position to answer this question. But since you have asked me, I will let him answer this question.
I give you the floor.
I don't know if we are doing things. So first of all, even if we do things that, for example, what China is doing, what if we adopt a policy that China has already executed? It will be different for us because our political society is different. The challenges are different. Right? So I really am not sure, but let me count a few things that I appreciate, things that have been done recently. For example, GST is one thing. Insolvency and bankruptcy code. They are not conceptually new ideas. They have been executed in developed countries, some developing countries. But our challenges were different, and to that extent, it's a different experience, even if ideas are not new. Similarly, production-linked incentives made in India. These schemes, Chinese and several other countries have adopted similar schemes, but today we are focusing on them. And again, it's a different experience. It's not a great answer, but that's all. Okay. I promise I will stick around to take your questions.
This is a question from a sociologist. It's not from an economist. Is this problem of underreporting the cultural one?
I think so.
And if you compare it with European countries, and if you see the data in the same way, do you get the same kind of equation?
So, as to the empirical analysis, my belief is that this kind of analysis has not been done, to my knowledge, anywhere. At households, this relationship has not been examined empirically. At group levels, there are some studies, mostly by Thomas Piketty and his team. You can get broad patterns, but not a systematic study. So we do not know. Whatever I can see from the broad patterns that I see, our problem seems to be worse. The problem of what I call underreporting seems to be acute worse. And I believe that it's cultural. There's something. I have only one anecdotal evidence, which is that one of my co-authors is Germany. And Germany is an economy that is cash-dominated economy. They for some reasons, their use of cash is much higher than digital transactions within the context of European countries. And so I asked if they would, if buy and sell a property, I asked if, do you pay tax when you sell a property? They do something similar to our stamp duty. So I asked, would you not underreport? He said no. I said, but why not? So he was thinking about the answer. For us, the answers, come very naturally. We want to sell on tax liability, underreport. I think it's a culture.
There is no way in which at the central level you can record your properties. You have to limit land properties. Because, I can own land in any part of India and even abroad. So there's no central way in where, the record of rights in land.
At the moment, there's no, but I think we should have, just like, linking bank account with Aadhaar. Every property should be given a digital identity and number, and it should be linked with the Aadhaar of the owners. It is possible, but we are.
That is not mandatory.
It is today. It is not. Today it is not.
Yes.
But what I take away from your question is something like this can.
We
Yeah,
can
but
consider
we-
land sitting laws and others.
Yes, and we make big fun of those laws.
Yeah, a very quick clarificatory question. The discussion has moved ahead to the policy level and so on. But the summary statistics and the graphs tell the consistent story. I was just thinking about the regulation results. So we had seen the OLS results, right? So I was thinking, is there a possibility of reverse causality between, because we have a ratio on the left hand side and the log of wealth on the right hand side. And I was thinking, like, I understand that the huge component of wealth is capital gains compared to the labor income or other sources of income. So, but still, higher levels of income, very high levels of income can amass a very large amount of wealth, and that can create a reverse correlation problem. So, in the paper, is it addressed or?
This is great. I must compliment students here.
He's a psychiatrist.
It's a compliment on two counts, on quality of profession and also.
It looks like a student is not a faculty.
I sense that. So compliment on two counts on your. The second count you got. So this is an important issue. I thought about it, but these 2 years, for reverse causality, the process is that the feedback mechanism between wealth and income, it plays out in terms of decades and centuries. So if you look at income wealth ratios, they change. There are very little changes, and those changes happen, at a minimum span of quarter of a century. So there, this issue can play out. Here, first of all, I don't have data to address this issue, and my hope is that in such a short span, this issue will not arise.
And if you allow the very quick, you have imputed returns to land ownership, investment in the land. May I know the data source for that?
Returns on land.
I mean, for computing how much how much the returns on investment is that.
So yeah, that's easy to answer. I would also encourage you to read the paper. I'm happy to share the paper with you. So that for returns on land, what I have done is I have collected the information on average rental income in cities. So the maximum I have seen is 3.5%. Rental income is on average. Let me answer your question. So for commercial property, what I have done is I have taken minimum range to be 0.8 and maximum to be 4%, higher than 3.5%. A similar approach is adopted with respect to agricultural land. So I have estimated over a range, and from this range. So what you see here, these are these bands are because of that range. So even with this kind of this much degree of freedom, the patterns remain very consistent.
So essentially, you collected the data, right? Or
from second, for example, for farmland, the land area is the value of land is there is mentioned in the affidavits directly. The rental income data is second resources are used to estimate rental income, similarly farm income.
Thank you. Thank you.
Can you highlight the education part of candidate of how it's behaving with reporting their income?
So that Okay, so I will have to check. Let me see what do the results look like. So, yes, the reported income increases with educational attainments in the data. I mean, this does not mean that educated ones are more honest. So maybe, for given wealth level, more educated you are, more is your labor income on average. So more income you report. Perhaps that's it. Other thing that might interest here is women report less income. And again, it's not that women are less honest. It's not that. I think it's the labor market outcomes are different for men and women. And similarly, labor market outcomes also depend on your educational attainments, and that's reflected in the reporting behavior.
Would it also be because women institutionally, actually, there is a wealth gap between.
So controlling for wealth. If you and I are at same wealth level, you report less income. That's what it's. But that's why I feel it's labor market outcomes that are responsible.
Okay, sir, shall we conclude if there is no other serious question? You can discuss. Yeah. So,
He'll be here for a few minutes.
yeah.
Sir, you discussed about underreporting of income in India, and there is a huge inequality in farmers' income. So, 85% of farmers' household they earn 9% of total farming income, and remaining 15% they own 91%. So, like, how do we manage? Like, how do we fit that data into this? Like, there's a huge inequality in farming.
So this study is not on the inequality as such. So this is only the relationship between your wealth and your income, you report, and my wealth and the income I report. So now, so it's not on inequality itself, but if your question is how they have been represented here. So that is there thanks to reservation. And of course, some people are motivated, they want to contest. So this data set, it covers, it has households that have reported zero wealth in few hundreds and few thousands. So they find representation. Their representation is not proportional to their share in the population, but they are there. Yeah, because thanks to reservation for SC/STs, who tend to be economically less wealthy, poor. They also are represented.
Okay, thank you. So I hope all of you will join.
Thank you. It was a great pleasure. I forgot about the little tiredness that I felt before stepping into the room. Thank you. Thank you so much.
Thank you.
Okay, thank you so much.